Is EQIX a buy or a sell? Let's get started with the model. This is a large cap company, 91 billion market cap. They're trading at $9.43 a share, and they have 97 million shares outstanding. This company is the world's largest digital infrastructure company. It operates 260 data centers across the world. It works with companies like Amazon and Apple. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They had $2.5 billion of free cash flow in 2021, and it goes up each year. $3.3 billion in the trailing 12 months. Really nice margins. They convert nearly 40% of their revenue to free cash flow. Net income is a profit or loss on the income statement. It's revenue minus expenses. And that more than doubles from $500 million to over $1 billion. Margins between 8 and 12%. Revenue is a sales for the company, and that goes up each year from $6.6 billion to $8.6 billion. Like most REITs, they pay a dividend, 1.8%, and they can cover that dividend 2 times with their free cash flow. We estimated 4 years of future free cash flows. We also estimated a terminal value to all cash flows past year 4, that's $128 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $110 billion. We divide that by 97 million shares. And we get a calculated stock price of $11.35. They're trading at $9.43, so they're trading at a 17% discount. It's a buy according to the model. Do you think it's a buy or a sell? Let me know in the comments. There are 18 companies in the same industry as EQIX, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend the most in CapEx, $3.6 billion. These are the investments in property, plant, and equipment. Their debt-to-equity ratio is close to the median. They're at 1.4 for every dollar of equity, $1.40 of debt. They pay a small dividend, only 1.8%, the lowest on this list. Well, I guess Power REIT is the lowest at 0, but the lowest of the companies that pay a dividend. They generate $3.3 billion of free cash flow, second to American Tower. They're the largest company on this list. The stock market is implying lots of growth in the future. When a company has really high price multiples, then that means investors think the company will grow a lot. I didn't say they will grow a lot because nobody really knows. But the reason the stock price is so high relative to its fundamentals is because of the future growth possibilities. So all their price multiples are worse than the median. The only one better than the average is the price of free cash flow. That's 28. The average is 63. They generate $8.6 billion of revenue, second to American Tower. And their 5-year annual revenue growth rate is pretty good. But you'd want to see something closer to Gladstone, 20%, if you're taking the risk of buying a stock with an 86 PE ratio. The stock is trading pretty close to its 52-week high. That was $9.85. It's currently $9.43, only 4% below its 52-week high, 36% above its 52-week low. So if you bought the stock at the 52-week low, you're up 36%. If you put $10,000 into this company 10 years ago and reinvested the dividends, you'd be killing it at $52,000 today, an 18% annual return. To summarize, I have them trading at a 17% discount, ranking 6 out of 10. I don't think I would buy it short term, but long term I think it's a good value. I think if you hold it for several years, you should do well. If you hold it for a few months, could be a little risky. Ratios 2 out of 10, pretty weak ratios. Financials look decent, so that's 6 out of 10. They do go up each year. Not a ton of growth, but a modest growth. Here's their income statement. Third quarter of 23, third quarter of 24. Revenue up a little bit from $2.1 billion to $2.2 billion. Let's see if they give a breakdown of the revenue. Of the $2.2 billion of revenue, $1.5 billion is colocation, $380 million interconnection, $118 million managed infrastructure, and $37 million of other. What they mean by colocation is when the company rents space and uses their products in that space. So this company uses their hardware and data storage in a space they rent from another company. Interconnection is the private exchange of data between businesses. Another way to say it, it's the deployment of IT traffic exchange points that integrate direct private connections between counterparties. They also show revenue by country. In the Americas, $958 million of revenue, EMEA $740 million, APAC $500 million. That's how you get to $2.2 billion. Most of their revenue is recurring, meaning somebody is set up on a subscription. 94% of their revenue, or $2.1 billion. Only 6% is non-recurring. So these are ad hoc services, $142 million of revenue. Their recurring revenue is up 5%, non-recurring up 42%. So total revenue up 7% when you compare 3Q23 to 3Q24. Here's a visual of revenue by country. In the Americas, it went from $913 million to $958 million. EMEA went up. Also, APAC went up. Let's go back to the income statement. Below revenue is cost of revenue. These are all the expenses directly related to generating the revenue. $1.1 billion. Here's a breakdown of cost of revenue by location. $446 million in the Americas, $387 million EMEA, and $265 million APAC. Cost of revenue in the Americas is 47% of their revenue, which is the lowest. EMEA is 52%. And APAC is 53%. So APAC's margins are the lowest since cost of revenue is 53%. That means their profit margin is 47%, their gross profit margin. America's gross profit margin is 53%. Then you have sales and marketing, $237 million. Here's a breakdown of the $237 million. $147 million in the Americas, 53% EMEA, 37% APAC. Sales and marketing in Americas is the most as a percent of revenue, 15%. It's only 7% in EMEA and APAC. The increase in sales and marketing in the Americas was higher bad debt expense, also higher advertising and consulting costs. General and administrative expenses, $434 million. Here's a breakdown, $293 million in the Americas, $82 million EMEA, $59 million APAC. And here is as a percent of the revenue by that location. It's the most in the Americas, 31% of their revenue is G&A. EMEA is 11%, APAC is 12%. Here's the reason for the increase in the Americas. $13 million of higher depreciation expenses. That's associated with back office systems to support the growth of their business. Also $12 million of higher office expenses due to additional software and support services. They have $7 million of transaction costs, so their total operating expenses $1.8 billion. Operating income $425 million. It was $381 million last year. Interest income, this is the interest they receive on their investments, $35 million. Interest expense $117 million. This is the interest they pay in their debt. So pre-tax income $350 million. $54 million of income taxes. Net income $296 million. And they have 95 million shares outstanding. Net income over shares outstanding gives you your EPS of 311. Last year it was 294. Last year they had less shares outstanding, 93.7 million. So they added about 1.5 million shares. But their net income went up more, so that's why their EPS is up from last year. Let's look at their balance sheet. Current assets $5 billion, current liabilities $4.4 billion. So current ratio is above 1. Current ratio is current assets over current liabilities. They have $2.8 billion of cash. They have $450 million of short-term investments. This could be CDs or corporate bonds. Here's a breakdown of their liquid investments. $1.6 billion of money market funds. $1.3 billion of time deposits. A CD is a time deposit. They footnote at number 2. Loan receivable, $224 million. Derivatives, $303 million. So you can see they list level 1, level 2, and level 3. Let me show you what that is. Level 1 assets are liquid and easy to value based on publicly quoted market prices. Level 2 is harder to value, but they can be reasonably extrapolated based off of some information. Level 3 is difficult to value. The way level 3 assets are valued is using internal models. So the only level 3 is loan receivable. Level 2 is CDs and derivatives. Level 1 is money market funds and CDs. I guess these are different types of CDs. Maybe they're not CDs at all. I just think of time deposits as CDs. Then you have accounts receivables. This is how much money other companies owe them when they sell their products on credit. $1.1 billion. $700 million of other current assets. Their total assets are $35 billion, a lot of PP&E, $20 billion. Here's a breakdown of the PP&E by location: 9 billion in the Americas, 7 billion in EMEA, 4 billion in APAC. Then you have right of use assets, 1.5 billion. These are assets that another company owns, but they lease. Here's a breakdown by location: 400 million in the Americas, 400 million in EMEA, 700 million in APAC. Then you have goodwill, 5.8 billion. Goodwill is the premium you pay when you acquire another company. Intangible assets, 1.5 billion. And other long-term assets, 1.9 billion. 22 billion of liabilities. Their biggest liability is long-term debt, 12.4 billion. Here's a breakdown of long-term debt. 1 billion is due this year. Effective rate is 2.79%. This is the rate on the note, 2.625%. But when you take into account compounding, you get the effective rate. European notes have a much lower interest rate. This is 0.25%, 556 million. The effective rate is 0.45%. The highest rate looks like 5.7% on this 2034 senior note. They also have Japanese yen notes and Swiss franc. The furthest maturity date is 2052. That's 3.4%. That's $500 million. Assets minus liabilities equals equity, 14 billion of equity. They raised 20 billion from selling their business, selling stock, and they profited 4.8 billion from running their business. The sum of their prior net incomes is 4.8 billion. They paid out 10 billion of dividends. Not many companies break apart dividends. I think this is the first time I've seen it. Let's look at the statement of cash flows. So for the trailing 9 months, they had operating cash flow of 2.3 billion. Last year it was 2.2 billion. This is how much cash they generate from running their day-to-day business. They spent 2.1 billion on the purchase of PP&E. REITs buy a lot of assets. In the financing section, they paid 1.2 billion of dividends. They issued 1 billion of stock, and they added 1.5 billion of debt. Let's look at a company on Simply Wall Street. Its last price, $943, 90 billion market cap, flat in the past week, up 16% in the past year. The stock started trading in the year 2000 at about $500 a share. And then 3 years later, in 2003, it got down to $3. So you could have lost your life savings on this company. Here's a Motley Fool article. They never had a regular stock split, but in 2002, they did a reverse stock split, a 1 for 32. If you look at a stock chart, all prices before the reverse stock split should be divided by 32. That's why it looks so high at IPO, because it's 32x what it actually IPO'd for. It probably IPO'd for like 15 or 16 because the stock price got really low, well below $1, so they did a reverse stock split to stay afloat. Let's read what Motley Fool says about this company. It is not your typical AI stock. They are a REIT and the world's largest data center REIT, giving investors exposure to the AI boom from another angle. As a REIT, its growth rates tend to be modest, but the company still has a huge growth opportunity in front of it, especially with the boom in data centers from AI. So you could have got the stock for $3 and then 300x your investment because it broke through 900 in November. It got pretty close to 1,000 in December, but it's come down a little bit since that peak, trading in the mid 900s. Simply Wall Street's valuation is $1,600. They say the stock is 42% undervalued. 23 analysts priced this stock at $1,000. They say it's 6% undervalued. Here's their revenue since 2014. It was $2.2 billion. It doubled over the next 3 years. By December 2017, it was $4.3 billion. It almost doubled since that point. It went from 4.3 to 8.1. Like most REITs, they have a lot of debt. It was $3.8 billion in 2014. Now it's $15 billion. Their equity is pretty close to their debt. Equity of $13.6 billion, debt of $15.2 billion. So their debt is 112% of their equity. And they have $2.8 billion of cash on their balance sheet. Plenty to service the debt. It's about 18% of their debt is in cash. This blue line is their dividend yield. It was highest in 2015 at 2.8%. The forecast for 2027 is 2.4%. And here's their quarterly dividend payments, and they raise it each year. They did pay a special dividend of $10.95 in 2015. That must have been a really good quarter. There are no insider buys, just sells. Lots of people selling the stock. 98% of the company is owned by institutions and 2% by the general public. Vanguard is the biggest shareholder at 13%, then BlackRock. Principal Global at 2%. ClearBridge Investments at 1%. And to round out the list, TIAA-CREF. Their employee count has gone up a ton from 4,000 to 13,000. And their ticker trades on the Nasdaq, Deutsche Börse, London Stock Exchange, Mexican Bolsa, Wiener Börse, and Sao Paulo Bolsa. So if you want a copy of my discounted cash flow model, click on the video in the top right corner.